If you are a young investor, you need to do this right now. If you're in your 20s or 30s and you're focused strictly on value stocks and dividends, you might be playing the wrong game. Now, let me be clear. If you're young, you need to prioritize growth in your portfolio. In this video, I'm breaking down why growth investing gives you a massive advantage when you're young, how it outperforms over time, and why playing it safe could actually cost you millions in the long run. The biggest advantage you have when you're young is time. You have time on your side. When you're young, your number one investing advantage isn't money, it's time. You have time to ride the market's ups and downs, you have time to recover from mistakes, and you have time to let compound growth work its magic. Value stocks can give you a 3 to 4% dividend, but growth stocks, they can double, triple, 10x your portfolio over a decade, easily. And the thing is, when you're a 25-year-old with an open road ahead of you, 40 plus years of compounding left, one high growth decade early on in your career can change your life forever. What is growth investing? Growth investing means putting your money into companies that are expanding rapidly in revenue, they're expanding in users, they're expanding in products, or even market share for that matter. Think of companies like Apple in the 2000s, Amazon in 2010, Nvidia during this AI era, or Tesla during the boom of 2015 to 2022. And I get it, guys. These aren't what we call cheap stocks, right? They're not cheap by any means, but in fact, they often look expensive. But I will tell you this, their growth potential makes it all worth it. They don't pay much in dividends, if they even pay a dividend at all, but that's okay because they reinvest profits to fuel future gains. That's rocket fuel for long-term wealth. Value versus growth numbers. Show me the numbers. Historically speaking, value stocks outperform in short-term recessions, but over the long haul, growth stocks have dominated by a long shot. From 2009 to 2021, growth stocks have literally obliterated value stocks. And sure, I agree with people when they say that value stocks do feel a lot safer. They move slower, they're more stable, and they pay pretty decent dividends. But safety isn't always what you're looking for in your 20s. I mean, let's be real, guys. I went to college. I was in my 20s too. In your 20s, you're like pretty much a walking, talking risk. 90% of the things you do are risky. You like to drive fast. You like to spend a lot of money on things that you don't need. You drink a ton. You guys go out there, you meet a chick at the bar, you shoot the club up. You know what I'm talking about? Like, you guys are walking, talking risks. So if you invest money in a stock that could potentially give you 10x, 20x, 30x return over the next 20 years of your life, that's not that bad of a risk compared to the risk you're taking on a daily basis. So I say all of that to say this, guys. You need velocity. You need compounding fuel, and growth stocks will deliver that. So let me tell you why growth works best when you're young. Let's say you're a 25-year-old dude and you invest $5,000 a year for the next 10 years in high growth stocks that are averaging about 12% annually. You stop investing completely after 10 years. Then you compare that to someone who starts investing $5,000 a year at the age of 35 and they're completely invested in value stocks, averaging about 6% a year. And they keep doing this for 30 years till they're 65 years old. Who do you think ends up with more money in the long run by the time of retirement? Duh, the 25-year-old does. And why is this, you might ask? Why does the guy that invests for 20 years longer lose and the 25-year-old win? Well, it's simple. It's because growth plus time equals exponential returns. Starting early, even with less money, wins 99% of the time. And don't get me wrong, if you're older and you're watching this video, capital preservation becomes more important. But when you're young and you're in your 20s or early 30s, you want capital acceleration. Now, how do you start investing in growth stocks right now? So if you're pretty new to investing and you have no idea what you're doing, you don't know how to look at a company, at a balance sheet, you don't know what to look for, you don't know how to do any research on stocks, you can still get started with growth investing. You just have to do simple ETFs like the Vanguard Growth ETF, VUG, or you can even put money into the Triple Q, which is very heavily exposed to the tech sector. Or if you feel that you do know what you're doing a little bit, you've been doing this for a couple of years, you're getting pretty good with investing, and you look at these companies and their revenues are growing quarter over quarter and they're scaling nicely, and you want to pick companies like Nvidia or Meta or even like a company like SoFi, which is a smaller cap, or HIMS, these smaller stocks at the age of 20, man, you can literally change your life by the time you're 35. These could like 100x. They have the capacity. Some of these smaller caps, you could 100x your investment over the next 15 years. So all in all, you're going to have to do a little bit of homework. You're going to have to do a little bit of homework. You're going to have to put some sweat equity into this. I mean, you could watch other creators. There's a lot of people on YouTube that put out good information. Do your homework, guys. Put in a little bit of legwork. Follow some of these people that talk about these good companies and do your research, because if you invest in companies that have scalable business models, most likely you're going to be pretty good in the long run. And with that being said, always think long-term. Growth investing is a marathon, guys. This is not a sprint. I talk to friends of mine that, have seen the channel and they know that I'm big into the stock market, and they ask me like, hey, Johan, I have some money that I could invest for the long term. They say the long term. And, I don't need it for the next 2 years. I'm like, dude, don't even invest that money, because if you're going to buy a house or you're going to buy another rental property, you cannot risk investing that money. And then the market has a downturn for the next 18 months, 24 months. And now you lost 25% of that money. Long-term, guys, you have to literally make believe the money doesn't exist. Leave it there. You want it to be there 10 years from now. Reevaluate it 10 years from now. If you want to take it out in 10 years, do as you please. Or if you're up and you want to cash it out to buy a house and you made a lot of profit, nobody's ever gone broke taking profit. I will admit that. So to wrap this up, give you guys my final thoughts on this debate. Do not play it too safe too soon. If you're a young person right now and you're watching this video, especially if you're in your 20s, and all you're doing is buying dividend stocks and value plays because they seem safer, guys, you're cutting yourselves short. Trust me. There will be a time where you could shift your investment strategy to income and preservation, but that'll be a lot later. That's 40 to 45 years down the road. Right now, you're 21, 22, 23. You're in your prime for building wealth, taking calculated risks, and letting time do the heavy lifting for you. Don't waste your youth chasing a 4% yield when you could be stacking 3 to 5x returns on multiple stocks. I mean, it doesn't even make sense. So if this video helped you rethink your investment game and you got some knowledge out of this video, please give this video a big thumbs up and make sure to subscribe to the channel. With all that said, thank you guys for watching. I will catch you on the next one. And remember, knowing this stuff pays, literally. Invest wisely, live free, guys. Catch you on the next one.